Hello, everyone, and welcome to Thursday Talks with Chug. Each week, we cover pressing topics that matter to you and your business. I'm Arianna Gonzalez from Chug, attorneys and CPAs tuning in from our San Diego office. Please join me in welcoming Attorney Vrinda Agarwal and Associate Attorney Megha Agrawal from our Santa Clara office. Hi there, Vrinda and Megha, and welcome. Thank you so much for being here. For today's topic, we will be discussing the ins and outs of venture capital financing. Just a quick disclaimer before we get started, this conversation is for informational purposes only and does not create an attorney-client relationship. If you have any questions, please comment them below or email us anytime at info@chug.com. So let's get right into it. Can you tell me what is venture capital and how does it differ from other forms of financing?
Hi, Arianna. Thank you so much. Pleasure to be here. To start with, venture capital is a type of financing where firms or individual investors give money to startups and to small businesses. And typically, these companies are those that have not yet gone to market or not yet started making money, but there's a potential for significant growth. And in exchange for the capital that the investor provides, they're looking for equity. Now, this form of financing is very different from traditional loans because there's no requirement of prepayment of interest. VC investments are looking for equity, which means that they want to profit if and when the company eventually becomes successful. And also, VCs typically target high growth industries like tech and biotech. And then they take a very active role in guiding these companies by even offering them mentorship and support. So it's not just about capital. In the last few years, we've seen some very significant VC-backed companies, including the likes of Uber, Airbnb, Facebook, and Google.
Wow, really great information there. So what's the difference between venture capital and private equity? Does one of you have information on that?
Sure, Ariana. Thank you so much. So, venture capital focuses on investing in early stage startups that have high growth potential and often in innovative and technology sector, whereas private equity, they typically invest in more mature company, often taking control over profitability and to drive the operations of the company. While both the types of funding are very similar, but they target different stages of the company. So they have different business life cycles and different strategies for value creation.
Wow, really good to know. Thank you for sharing that with us. Can you tell us how venture capitalists typically elevate startup companies for investment? How do they get it to the stage?
So there are a few things they look at. Firstly, they're looking for a strong founding team. That's really the core requirement because these startups are led by founders who are responsible for everything. And it's important from the VC's perspective that the founding team has relevant experience because that's crucial for success here. Then VCs also look at the market opportunities. Like if the startup is in a large or a fast growing market, then that's something that would catch their eye. And the business model is important as well. Of course, the VC fund wants to know how they're going to make money. And so they're going to evaluate the product or the service, and they would look for something unique, something that's capable of creating traction in terms of user growth or revenue.
That's great information. And yes, very true. It is important to have a good foundation set up for your startup. If you are watching this and have any questions about how to set up your business to be ready for this, please reach out to us. We'd love to help you out. So what are the key stages of venture capital financing from seed to exit?
So venture capital financing have several key stages. It generally starts with seed stage, where entrepreneurs seek initial funding to develop their ideas and create prototypes. Once they have some traction, they move to Series A, where VCs invest more to help scale the business and improve the product. If all goes well and if things are good, the company then go to Seed B and later rounds, focusing on expanding market reach and operations. Finally, there is an exit stage where VCs aim to realize their returns, and often go through IPO or acquisition.
So, how much equity do startups typically give up in exchange for venture capital funding?
Yeah, so typically, startup companies give around 10 to 30% equity in exchange for VC funding. This is just a ballpark, though, and the exact percentage can vary based on several factors. Uh, Most importantly, it depends on the state at which the funding is happening. If it's an early seed stage funding, when the risks are higher, then the startup company would be willing to give a larger percentage as an incentive, and that percentage could be like 20 to 30%. But later, as the funding rounds progress, like when we get to a Series A or B, the percentage decreases because by that time the company has developed some traction, it has a stronger valuation as well. And so ultimately, it's a question of several factors being considered. Even negotiations play a big role here. It's about how the VC founders and the VC investor and the founder can negotiate, and then it depends on the startup's growth potential as well.
Wow, really good to know. I'm curious about how venture capital funding impacts the control and decision-making power of a startup's founders.
So when founders bring in VC money, they often give up a portion of equity in exchange for that investment, which can dilute their ownership stake. This dilution sometimes means that VCs gain a say in a key decision, and especially if they negotiate for board seat or particular voting rights. While this can lead to a valuable guidance and resources, it can also mean that founders have to navigate a very complex decision-making process, as they may need to consider the interest of their investors too.
Yes, that's very true. You do have to take into account what the advice of the investors is. So, what is the role of a lead investor in a venture capital round?
So the lead investor is actually the investor who plays the most crucial role in a VC round. This company or fund is kind of like the captain of the ship. They are the ones who put in the largest amount of capital, and they will kind of set the terms for the investment, and they will take the lead on negotiations. And then beyond just money, the lead investor is also bringing in expertise and connections, and these can, in course of time, help the startup navigate challenges, open the doors to new opportunities. The lead investor is also likely to take a board seat just by virtue of them putting in the most amount of capital, and through that board seat, then they can have a direct influence on the company's strategy. And actually, an important point here is that it's very rare for just one VC firm to completely fund a company. They usually work in groups of two or three for different financing stages. And this strategy is crucial because it helps them diversify their investments. It also reduces the workload for VC partners because they share responsibilities then for assessing risks and managing deals. And then from the startups and the founders' point of view, if there are multiple VC firms backing, that of course adds credibility, and other people then tend to follow suit.
Wow, great information. Do we have information on what advantages a lead investor has in negotiating terms compared to other investors? What does that look like?
So a lead investor has significant advantage when negotiating terms in a venture capital round, because they usually commit the largest amount of funding, and that gives them a leverage in discussion. They set the tone for the deal, they influence key aspects like valuation and specific investment terms. With their expertise and established relationship with the founder, they can advocate effectively for their interest while also fostering a collaborative atmosphere. This combination of financial commitment and expertise allows them to shape the deal in a way such that other investors are not able to achieve, and making their role even crucial to venture capital funding rounds.
That's good to know. Can you tell me what is the role of a venture capital term sheet and what are the key components?
Yeah, so a venture capital term sheet is perhaps the most crucial document in this entire process because it outlines the basic terms and conditions of the deal between the startups and the VCs. And it's kind of like a roadmap for the investment. It sets the stage for the more detailed agreements that follow. Key components that go into a term sheet include the amount of investment, the valuation of the company, how much percentage of equity the investors are getting. And it also talks about governance issues like board composition and voting rights, which eventually determine how much control the investors have. Now, when it comes to the term sheet and the legal agreements, in the US, we have something called the National Venture Capital Association, which is a trade association representing the venture capital industry here. And they've created a set of model legal documents which are quite widespreadly used in the industry. And in the early days of VC funding, there was no standard set of documents. Each deal was negotiated individually. So the process was, of course, time consuming, expensive. And in the mid 90s, then the NVCA stepped in and created this set of model legal documents, which have now really become a benchmark. And they're the starting point for negotiations between startups and VCs. And the key documents that are included in the NVCA templates are the term sheet, then also a stock purchase agreement, an investors' rights agreement, and a right of first refusal and co-sale agreement, and a voting agreement as well.
Wow, really good to know. Thank you for sharing all of that with us and going into so much detail. What about preferred shares? What are preferred shares in venture capital and why are they important?
So preferred shares are a special class of equity. They are very important in venture capital financing because they are the typical mode of issuing equity to VCs. And the reason that they are used is that they offer certain advantages over common stock. Firstly, if an investor is holding preferred shares, it means that they get priority in receiving dividends and assets if the company gets liquidated or sold. So that way, it's a safe option. A VC is, of course, committing a significant amount of capital sometimes to a very early stage company. So there is a risk that things could fall apart. And if they have this safety net of receiving at least their investment amount before any other stockholders get paid out, then that creates a huge incentive. And then preferred stockholders also come with additional rights such as anti-dilution protection and the ability to convert them into common shares. And all of these allow investors to then benefit from the company's growth.
Wow, that's really good to keep in mind and know. So what is the importance of board rights in VC deals? Do we have information on that?
So board rights are a very crucial aspect of VC deals because they give investors a say in the company's governance and in its strategic direction. And when VCs invest, they negotiate for the right to at least appoint one or two members to the company's board. This is really important for them because it allows them to monitor their investment, also to provide guidance to the company and influence its key decisions. For example, it can then influence decisions like hiring of executives, approving of budgets, and setting long-term strategies and plans. Now, here there's a little bit of an interesting dynamic going on between the founders and the VCs because the founders do want the VCs to come in on the board with their expertise and their connections. But also, when a VC gets a board right, then the founder is in some sense parting control over significant company decisions. So it's very important for the founders then to consider how many seats they would be willing to give up and to whom. And this is it's a fairly hotly contested point in these deals, you know. Investors want board rights and founders want to give them, but also still keep control.
Wow, great to know. So we often hear terms like drag along and tag along when it comes to venture capital. So can one of you tell me what are drag along and tag along rights in venture capital agreements?
Yeah. So drag along rights, they allow majority shareholders to force minority shareholders to sell their shares if there's a significant acquisition offer. And what this does is that it ensures that if a great deal comes along, then the process is not stalled by minority holders who want to stay on board. Tag-along rights are the opposite in the sense that they protect minority shareholders by giving them the option to join in slash tag along on a sale if the majority shareholders decide to sell their stake. So let's say the founders who in a startup have the maximum amount of equity are selling their shares, then the VC investor can also tag along and exit by selling their shares on similar terms, ensuring that they also get to benefit from that deal.
Got it. What about affirmative votes? What are they and why are they important in venture capital agreements?
Yeah, votes, again, like board rights, are a very important part of these deals, and we see them heavily negotiated. The reason being that they're a way to ensure that certain important decisions in the company are approved by the VC investors, and they protect the interests of VC investors by giving them a say on some crucial matters, and those matters can be changes in company structure, major financial decisions, or it can even be going for new funding rounds. So, if the company is making any sort of big moves, then it needs to take approval from the investor who has those affirmative voting rights. This way, the VC investor is not met with any major surprises. Essentially, it creates a safety net for them, ensuring that they're involved in key decisions that could impact their investment.
And how do investors leverage affirmative votes to protect their interests?
So investors leverage affirmative votes to protect their interest by ensuring that they have a say in critical decisions that could impact their investment. Decisions such as selling the company, taking on a new debt, changing business strategies, and so on, it has to be approved with those affirmative rights. And investors can still maintain control over the key aspects and decisions of the company. This means that they can prevent decisions that might be risky or unfavorable. Essentially, it gives them a voice in the company's direction and also helps safeguard their investment by ensuring that the major changes aligns with their interest and overall their vision of the company.
What about the venture capitalists? How do venture capitalists mitigate risk when investing in startups?
So there are several strategies they use to mitigate risk. Of course, the key approach is through doing a thorough due diligence, which means that before they actually invest capital, they investigate the startup's business model, they evaluate its market potential, they look into the founding team's backgrounds, and they also look at the company documents to make sure there are no historic liabilities. And then secondly, they tend to diversify their portfolios by investing in multiple startups across different industries, and this helps spread out the risk. And thirdly, when deals are being structured, and we talked about this earlier as well, they ask for provisions like affirmative voting rights, liquidation preference, and board seats. All of these give them some control and insight into operations, and that helps them mitigate risks.
Great insights. Thank you for sharing that with us. So, do we have a time frame for how long venture capitalists typically remain invested in a company before exiting?
Yes. So venture capitals typically stay invested in a company for about 5 to 10 years before seeking to exit. This period allows enough time for the startup to grow, refine its product, and hopefully achieve substantial market traction. During this time, venture capitals often work closely with the founders and they provide guidance and support to help maximize the company's values and profits. Once startup reach a certain stage, whether through a significant increase in the valuation or readiness for acquisition or maybe IPO, VCs will look to exit and realize the returns on their investment.
And what are the most common exit strategies for venture capital backed companies? Do we know that?
Yeah, the most common exit strategies are acquisitions and IPOs. Acquisitions are preferred because they provide a quicker return on investment. Basically, what happens in an acquisition is that a larger company buys the startup, and this allows the VC to cash out after the sale. IPO is another preferred method. It can potentially yield higher returns, but the gestation period is longer because the company has to go through the SEC filing process and meet some strict regulatory requirements. The third option is secondary sales, where the company's shares are sold to other investors or to private equity firms.
So a question we get quite often is how can startups attract the interest of venture capital investors? We have a lot of startup clients who want to attract the interest of venture capital investors. So what's the recommendation for this?
So it's really important to grab the attention of venture capital investors. It's all by showing what makes your startup so special. You should start by sharing your story. What inspired you to create your business? What's your values? What's your mission? What's the problem you're trying to solve? Then you should also highlight any impressive metrics that you may have, like growth or revenue, or showcase that you're gaining a lot of traction in the market. It is important to make sure that you talk about your team members too. Having a very strong and passionate group of members working behind your vision and for you, it can really resonate with the investors. So it's all in all, it's important to build a genuine relationship and then connect them with networking and personal referrals. And of course, don't forget to emphasize on big market opportunities. Let them see that there is a lot of potential for them for their significant returns on their investment. And then when you combine all of these elements together, you create a very compelling narrative story for them, which they can really get attracted to.
Great insights, Megha. Thank you for sharing that with us. So what is an initial public offering, also known as an IPO, and how is it related to venture capital?
So an IPO is when a private company decides to sell its shares to the public for the first time. And this way, everyday investors, like retail investors like you and me, can buy into the company. An IPO is very important in a venture capital deal because for VCs, this is a key exit strategy. And the reason that the key exit strategy is that it can provide the biggest return on their investment. Now, when a startup is going public, typically it means that it has grown significantly and it's ready for that next level of funding and visibility. And that's quite exciting for VCs because they can sell their shares on the stock market, they can cash out, and also they're leaving the company in a good shape because the company is then able to gain more resources to continue expanding. So, in a nutshell, an IPO is like a major milestone for both the company and for the VC investors.
Wow, great to know. I know we are close on time, but I want to ask you ladies one more question. How can a startup founder negotiate more favorable terms in a venture capital deal? Golden question.
Yes. So when it comes to negotiating better terms in a venture capital deal, it really starts with preparation. As a founder, you want to understand your company's values and what's happening in the market. So be prepared to do your homework first. And then you should also highlight your achievement. Showcase any traction you have gained so far, like number and revenue growth, because that adds weight to your position. Building relationship with investors is also important because if they know you and they trust you, they are more likely to be flexible. And don't be afraid to explore multiple funding options to create a bit of competition in the market. This can empower you during any multiple negotiations that you may have, and any multiple rounds of funding. Then, lastly, it's important to be clear about your vision of the company. It's like painting a very compelling picture of the future. And if that can really resonate with the investors, it can help you secure a more favorable terms. So, all in all, I would say it's important that you paint a very compelling picture which really attracts the investors.
Absolutely wonderful insights, ladies. Thank you so much for your time and sharing all of this great information with us. We really appreciate you. That is all we have time for today. So this brings us to the end of our conversation. Thank you everyone for joining us today. A special thank you to Vrinda and Megha for taking the time to share this amazing information with us. To stay up to date, please subscribe and follow us on Facebook, LinkedIn, and YouTube. If you have any questions or suggestions, email us anytime at info@choop.com. Let us know what topic you want to see next, and make sure to join us back here next week for more pressing topics that truly matter to you and your business. Until next time, stay safe and take care, everyone. Thank you so much, Vrinda and Megha, again. Thank you.